Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our periodic Investors Observer members only workshop. Welcome to everyone. Good afternoon, and thanks for coming. So here's our agenda for today. Talk a little bit about what's going on at Investors Observer. We're going to look at some charts, kind of talk about what else is happening in the economy, talk a little bit about what's happening with Chinese stocks in particular. And then the rest is member-driven content. We got a few good questions ahead of time, so we'll go through those. And then, yeah, the rest is questions that you can ask during the presentation. If you have questions now, you can go ahead and put them in the box. If you think of something while I'm talking, put it in the box as well. I keep the box open off to the side, so if you have a question about something I'm talking about in the moment, by all means, go ahead and throw it in there, and sometimes I'll try to get to those at the time. All right, so yeah, that's all I have for introduction, so let's get started. All right, so what's going on at Investors Observer? We are working on an Android app. We have gotten lots of questions about an Android app since we started to, since we launched the iPhone app. I guess it's all iOS, so iPhone and iPad. Yeah, it turns out that that's two big, entirely separate software development projects. And so we could have, done the Apple app and finished it and then sat on it until we had the Android app ready. But it really sort of made more sense to just push the Apple app out there. And so now we're working on the Android app. It should be finished later this year. Like I said, it's a pretty big project. But yeah, we are working on that and hope to have that done as soon as possible. And yeah, it will have all the features, all the same features as the iPhone app, which is all the stock stuff and the My Portfolio. There's no option stuff in there yet. And then you can get news alerts for your portfolio and watch list. So it's pretty carefully filtered to try to include only the most important things. We have noticed that on days where a stock in your portfolio, particularly if it's a big stock like Apple or a Facebook or something like that, you might get a lot of notifications. But otherwise, we try to keep it to things that are pretty important, and there's no marketing notifications for us or anything like that. All right. So let's look at some charts. Here's the last year of the S&P 500. I draw these lines periodically as support and resistance. We're above the most recent one, all-time highs. Again today on the S&P 500. There's not really a lot to report here, right? I mean, this is, things got a little nervous, let's say, a couple of weeks ago, but overall, there's really not a lot to get upset or worried about here. Things keep going up, but never getting, rarely getting so extended that it seems like a correction is necessarily necessary. Oh, that was the wrong button. All right, the Nasdaq. The Nasdaq's chart is a lot sort of sloppier. It's still, broadly speaking, up and to the right, which is, what you look for. We kind of had some bigger things going on back in the spring, and then it's been, I guess 4 days now since we set an all-time high on the Nasdaq, as opposed to yesterday and today for the Dow and the S&P. But that's totally fine. Still got an all-time high within the last week. It's not like we're in some sort of prolonged downturn for the Nasdaq. Keep doing that. All right, the Russell is a little bit more interesting. So the small caps have been in this sort of sideways range where the the 50-day moving average has barely moved for months. And there's a lot going on there. The Russell 2000 is the sort of broadest of the indices. It doesn't have the difference between the largest company and the smallest company is a lot different than the difference between, Apple in the S&P 500 and whatever company number 500 is there. So yeah, there's a lot going on here. Some of it's been biotech stocks and other sort of speculative technology things. But again, this is not. There are some stocks that are way up over this time and some that are down. But in general, this sort of sideways thing. I mean, there was a big run from September up until February. That's a pretty big move. So kind of expect some consolidation after that. And there's just been a lot of sort of churning where some stocks go up and some stocks go down, and then some different stocks go up while the stocks that were going up before go down. So there's still lots of stocks that are going up and have better looking charts than sort of the Russell here. But even then, this is not necessarily worrying. Sometimes things, rest or what have you, as they call it. All right, so the last year of the S&P 500 versus the S&P 500 equal weight. See, the equal weight was pretty sideways there for a while, but it started to go up again, where the S&P 500 is still, as we just looked at when we looked at just that chart, pretty much on trend, but the acceleration or the rate of climb may have slowed down a little bit, whereas after sort of a pause here, the equal weight sort of took a break. And again, the difference here is really about the performance of those 4 or 5 like mega cap tech names. Your Apple, your Google, Facebook, Microsoft. That's really what drives sort of the difference here, because those companies are so much bigger and also pretty concentrated in the same basic industry. So yeah, that's what's going on there. All right, so then growth versus value, which is another one we've been looking at, and there's been some sort of crisscrossing for a while. And this one you'll see that value, sort of rolled over, but then has been climbing back to be at a new high. Whereas the growth, which is the blue line here, rolled over earlier and has been climbing pretty sharply, but has kind of fallen off here in the last couple of days, which is, I don't know, let's call it interesting at this point. It's not a big enough move to try to draw much from it, but it does kind of get to some of the points we're going to make later in terms of, growth stocks tend to be, your smaller companies, your tech stocks, things like that. Companies that tend to fare worse when the cost of capital gets higher, which is what you start to talk about when you start to talk about higher interest rates. And so, I think that some of that slowdown in the rate of climb and the growth might be some of that. All right, so what else is going on? The Federal Reserve, or really guesses about the Federal Reserve, is really sort of driving markets right now. There's some single stock things going on due to earnings, but really pretty much everything is interest rates right now. The market's response to economic data is largely about what the Fed might do and not the actual news. So what that means is we get into this sort of, consumer price index came in sort of lower than expected today, which is good news. So stocks go up a little bit. We might start to see things where, like, oh, you get a miss on the, some employment data, and as long as it's not a huge miss, stocks might actually rally on that, because it means, okay, the economy is weaker than the Fed thought. They'll keep things lower for longer, or keep buying bonds, or whatever it is, as the case may be. And yeah, that CPI number this morning, the core number, which is, you sort of take out food and energy, because those tend to be volatile. Price increases for used cars slowed down a lot. Airfares, which is another category that's been rising super fast and pushing things up, actually fell. And yeah, prices for some things are still rising, but transitory still seems to be very much in play. The used car price thing could only go on for so long, right? at a certain point, people just won't pay that for a used car. And that's what happens, right? Like that's the difference between some sort of supply disruption or something like that and actual inflation. When you have actual inflation, what you have is there's essentially so much money in the economy chasing a relatively smaller pool of resources, and prices can keep going up and up and up and up. But as long as you see prices, prices sort of responding to prices in the sense of, what we see it in housing and used cars now, in terms of prices were going up super fast, and then they just sort of stop going up relatively suddenly. And the reason for that is it just gets to the point where people say, "Hey, this is crazy. I'm not paying this anymore. Or I can't pay this," or whatever it is. It gets to a point where things can't keep going up. And so, yeah, I mean, like I said, there's also lots of supply disruptions going on, right? This chip shortage thing seems like it's going to be going on for a long time, and basically everything else, comes to you via shipping container, which there are also shortages of right now. So there may not be production problems in a particular industry, but if they don't have the boxes to ship them from China to here or from wherever they're made to here, things can be hard to get, even though, production and demand are fine on both ends. But if you can't find room on a boat or a box to put it in to ship it, you're still going to have a problem, in terms of the supply. And the other thing we're seeing is productivity is rising along with wages. This means that employers are paying more, but they're also getting more. There's a story in the Wall Street Journal, I think last week, about a manufacturing business that has been paying more, and they found that, since they started paying more, they're getting a higher quality of job applicant. People are sticking around longer. There's all kinds of things that come with paying higher wages. It's not just higher costs. And so, yeah, that there's not really much going on there that's what I would call particularly worrisome in terms of the economic data. We're still, still climbing out of a hole. The policy response to this recession has been very different than the response in 2008, and I think that's made the recovery a lot faster. Also, the fact that it wasn't, sort of a financial crisis makes it a lot faster. But yeah, that's sort of where we are right now. All right, so hot right now. The things that are hot right now, if you look at stocks, are, sort of relatively speaking, by sector. Real estate, it's the residential and industrial REITs are doing really well. Retail REITs have also been strong, but you have to kind of pick and choose there a little bit. Those guys that just own indoor shopping malls, I'm still somewhat skeptical of. I mean, some of them are bouncing back because they, declared bankruptcy and managed not to totally liquidate the stock, but they still have some problems. And yeah, some of this is about interest rates, but there's also a lot of demand. So leases are getting renegotiated at higher prices. Some of your other stuff, right? Your office space REITs, especially in your big cities, are maybe having some trouble. But residential and industrial are doing really well. Consumer cyclical, back to school. We posted an article a little while ago about back to school is back. Apparel and footwear retailers are doing pretty well. And this is sort of part of the general trend of the economy, sort of reopening. But my kid didn't go to school last year. She stayed home the entire school year. And so, obviously we bought her new clothes as she outgrew them and needed new clothes, and the seasons change. She didn't stay in pajamas for a year, but we didn't necessarily do that big fall, like, all right, here's a new wardrobe. We also didn't buy a bunch of notebooks and stuff like that because she just didn't need them. And then industrial, the industrial sector is also doing well, right? Like specifically things like industrial distribution, rental and leasing, and both of those are about increasing production capacity. So industrial distribution is about like sort of, getting machine parts and some of those things around. And then rental and leasing a lot of times is people will rent or lease equipment, which maybe is either unavailable to buy or while they're trying to get financing, or they just don't want to buy the whole thing immediately, and so they rent it because it's sort of a different they're less confident in the economy, something like that. And then staffing and shipping, as you can probably guess, with all the talk of employee shortages and shipping capacity shortages are also doing well. So let me show you while I'm looking at this how we actually where I got this. This comes from the website. You can go to the sector and industry tab here, and so you can sort all of the sectors on the left and industries on the right by by our scoring systems. If you want to see sort of what stocks are up over the last month, you can look at that short-term technical score. If you want to see what's been hotter over longer term, the last 6 months or more, the long-term technical score is where you go. Analyst ranking, see what stocks, what sectors people have the analysts have the highest opinions on. You can do it like that. And this is a good way, right? Like these things change as the economy changes, right? All those charts we looked at, especially the comparison ones where it's like, oh, well, this was strong here and then this is strong here. This lets you drill down and sort of turn two lines intersecting into, data, and you can click through and be like, all right, healthcare, what are the stocks in healthcare that analysts like the most? Oh, here's a list of them. So yeah, that's how that works. All right. All right, so let's talk a little bit about Chinese stocks. So the Chinese stocks have all they were super hot for years. Alibaba had a big IPO, several years ago, and then there have been a couple other IPOs more recently. And Chinese stocks have been kind of a story in the market for a while. But more recently, they have been in the news for less favorable reasons. So let's talk about that a little bit. So in China, foreign ownership of Chinese companies is technically illegal. Okay. And so, obviously, if you're buying equity in a company, you are theoretically buying some ownership stake in that company, which, okay. So Chinese companies are, foreign owners are technically illegal. So Chinese companies have been using this sort of loophole where they set up what's called a variable interest entity structure, which is essentially a technicality that China so far has allowed. Okay, and we'll talk about how that structure works on the next slide. But yeah, the thing is, China remains a communist country. They've adopted some amount of capitalism, but only so far as it sort of advances the party's interests, right? The Communist Party is still very much in charge. And you've seen Jack Ma, who is the CEO of Alibaba and a couple other Chinese companies, and other billionaires sort of, maybe they'll say something or they'll do something the Communist Party doesn't like, and then they don't get seen for several weeks, and then they come back and they're very much in line with whatever the Communist Party doctrine is. So that is an interesting environment to think about for investors, right? Jack Ma's other company, Ant Financial, was supposed to hold an IPO earlier this year, and it got canceled like days before the offering was supposed to happen, and nobody saw Jack Ma in public for a couple of weeks. And yeah, nobody still knows what exactly is going to happen with Ant Financial, but it seems that it's not going to have that IPO anymore. And so what does serving the party's interests mean? Essentially, what value does China get from American investors making money on Chinese citizens spending money on education and ride sharing, which are the two sectors that have really been smacked in terms of Didi and then all the Chinese education stocks, TAL Education, the ticker EDU. There's a bunch of others, right? So does that advance China's interests at all? Really, I don't understand how it does. And so where we're at is China seems pretty happy to accept foreign investments in sectors that can help it project power abroad. And that means things that are not consumer software, right? So what China's interest in projecting power abroad is largely in sort of military or commercial or industrial applications. So we've seen no crackdown on the investing in the automobile sector, drones, other pieces of technology, various other tangible goods that either could compete with existing world powers or contribute to military technology. Okay? China seems thus far pretty happy to accept Chinese investment there. Granted, a lot of the companies in those spaces are not yet profitable. And so where the education companies were starting to turn a profit and make money, these companies are not yet. So it's really just, right, money flowing into China from abroad to prop up these industries. And yeah, ultimately the fate of those investments will be sort of like we saw with the education and ride-sharing sectors, whatever serves the party. You might make a quick buck as the stocks go up, right? Like lots of investors in America made money on those education stocks as they went up. But you know, if you're holding the stock when China decides, yeah, we're not actually letting the capital flow back out the other way. I know these people think they own the company and have some claim on the earnings, but you know, again, where that fits the Chinese, Communist Party's interests is sort of a question. And so it'll be interesting to see what happens with those stocks that haven't been sort of smacked around. But yeah, all right. So let's look at that variable interest entity structure. So this is from DD's S1, right? They told everybody this was the structure before their IPO. And so this DD Global Incorporated from the Cayman Islands is what the American ticker DIDI is an investment in. So you're buying shares in the Cayman Islands company. And so all these things that have an arrow, a one-sided arrow, or things that this company owns. And these little things aren't really much to speak of. The big revenue is down here at the bottom, right? These DD things that are actually onshore in China. But to get to onshore China, you have to go from the Cayman Islands to this company that's based in Hong Kong, which has its own sort of, let's say, questionable legal status right now in China. And then we get to the onshore piece. And so this Hong Kong company owns Beijing DD Infinity Technology and Development. And then we get to these other arrows. Okay, so this arrow means that there isn't actually an ownership relationship, but a contractual relationship. Okay, and you can write a contract that you'll sell somebody something at cost or well above cost. So this contract here essentially says that this company will give all its profits to this company. But that's a contract. It's not ownership or legal, and contracts can be voided or overturned or not renewed. Right, but this sort of weird structure is how we get around the law. And so then when you get down here to the companies that are actually making the money, and growing fast and delivering things in China, right, you can see like, so what exactly is the claim you have on earnings up here? It gets hard to tell. And that's assuming that China just doesn't say the structure is now illegal, everything above the line goes away. Which is also possible in a communist country, right? Like you own everything that the party says you own, and nothing more and nothing less. So yeah, that's what's happening with Chinese stocks, right? There's obviously tremendous opportunity there. They have a giant population and a fast-growing economy. But what exactly your claim to those future profits are is certainly more of a question now than it was a month ago. All right, let's get to the questions. So Stan asked essentially if we could show how to effectively use IO to short stocks or use it to benefit when the market goes down, or also how to use IO to hedge or protect an existing account to protect from a market correction. And so yeah, the stock is set up to feature things with high scores. Because most investors are long only. You can certainly screen for ratings with low scores. In the stock screener, you can, that sector and industry page I was looking at or showing you earlier, you can look at the bottom of the list instead of the top of the list. Look for industries that are performing poorly. Really, the inverse of any long strategy should probably work as a short strategy, right? Instead of good fundamentals and weak charts being a way to find sort of things that are undervalued, maybe look for stocks that keep going up despite poor fundamentals, things like that, right? So anything that is a reasonable way to find a long strategy, if you figure out what the sort of opposite of that is, then that seems like a not unreasonable way to find a short strategy. But how to hedge or protect an existing account from a market correction? Really, diversification is the key, right? You trim the big winners, and what that ends up meaning is, you're selling the things that are winning, and maybe buying the parts of your portfolio that have underperformed and gotten sort of smaller, relatively to the whole of the portfolio. But generally, if you have so much in stocks that you're very worried about it, the solution is to have less in stocks, right? If you're worried your car is gonna catch on fire, you don't, try to find some new car insurance policy. You try to fix the car, right? And this is the same thing, right? There's spending money to protect something from crashing is, one way to do it, but also just sort of, trying to solve for minimizing the number of crashes you're exposed to is a better strategy. It's also important to remember that there's no prize for having a high daily average balance, right? If you sell at the top and then buy back in at the same price when things go back up, sure, you end up, at the same place you would. But selling at the top every time, is really difficult. And I guess you could sell at the top and buy back in at the bottom. But nobody successfully times the market for any length of time. So you really, if you're gonna play this game, you have to be ready to ride through some volatility. And the key is really just to have the right amount of risk. So, next month's rent shouldn't be in stocks, right? Money you need to grow but won't need for years probably shouldn't be in a savings account where you're not making any money either. So it's, investing like, any other sort of business is really about sort of understanding what the risks are and deploying the resources at your disposal, which is essentially money in this case, appropriately. And so, if you have, huge stock gains, then maybe it's time to take some off the table, especially if it's the thing you're losing sleep about or something like that. All right. So Barry said he'd been watching ATOS for a few months, profited on a couple of trades, still has a price target of $7 and a buy rating from the average analyst. It hit 980 earlier in the year, and now it's trading at about 3. What happened to the stock to take such a tumble? The thing here is, right, like this is trading biotech stocks. Biotech stocks are going to be biotech stocks. If you scroll through the news on ATOS, which we'll do in a second here, it's full of stories that mention double-digit moves, some up, some down. Right, like that's kind of what happens. The stock got a lot of hype in May and June, had a lot of just sort of news about it in terms of there were some drug trials and it got added to some indices. And it just sort of seems to have gotten ahead of itself. But generally speaking, biotech is a very risky business, right? Like you spend years doing very expensive science experiments, and you hope to end up with a product that works and makes millions or billions of dollars. Until that happens, though, it's basically about trying to manage how much cash you're burning, and in a lot of cases, trying to sell shares when the stock is high. So you see this sort of more and more in terms of, a company will have some positive news about it, and then shortly thereafter will announce a share sale. That's, it's basic trading, right? You try to sell stocks when they're high. So that part makes sense. It can be upsetting to investors, though, because as soon as the stock starts going up, the company steps in with a bunch of supply and seemingly sort of snuffs out the rally, but the company cares less about the stock price than they do about funding their continuing operations, and so that's why that makes sense. All right, so let's go look at ATOS for a second here. All right. So yeah, I mean, the price target is still $7. Analysts still have a strong buy on it. The current price is a little over $3. But if you look at this chart, yeah, it went crazy in June and July, but if you bought it most days in the past year, you're still ahead of the game, which is, I think, a thing that's important to remember. But let's look at the news here, because this is where it gets interesting. So yeah, I mean, the most recent news is they want to essentially be able to sell more shares, and they're out of the authorized share numbers. They need to raise that. But yeah, here's drops 11%. Here's plunges amid heavy volume. Here's, approval to start a drug trial, which is a positive. Rally continues, added to some indexes. Regulatory approval, stock down 22%, stock down 10%, up 35. And this is, a little bit of an outlier, but it's also a very small company that, doesn't make any money. Has things in pretty early stage trials, it appears, just based on these headlines here. Right, I mean, a 1/2 trial means you haven't gotten to phase 1 yet. Maybe that's a 1/2 trial. Either way, that's a pretty early, pretty early in the drug approval process. And so, yeah, things like that tend to be very volatile and move around on news, because it's not a question of is management executing, the correct business strategy for the underlying business. It's, will the cash they're burning pay off in terms of a product that they can sell and try to get it back at some point. Yeah. All right. So Kavork asked if we could talk about Moderna, mRNA, which, yeah, also has an interesting chart. It's down quite a bit a couple days ago. So yeah, Moderna's chart looks a little bit like Atos did in June. The company is profitable. It's gotten pretty famous for making a successful COVID vaccine. But yeah, the stock is also, even today, after it had that big drop, is up more than 300% this year. At the peak on Monday, it was up almost 70% since the middle of July, which is like less than 4 weeks. So that's, a big move for a company that's valued at over $100 billion. And so, yeah, vaccine stocks have been super hot, probably because they've all posted huge earnings numbers in the last couple of weeks. The outlook looks good. But again, right, at a certain point, stocks come back to, the net present value of future cash flows is the sort of academic definition of it. But what that means is, am I going to get some value back for my ownership of this stock, whether it's a dividend or whether the company, buys back shares? In some way, something has to come back the other way, right? So is there anything about Moderna that looks 300% better than it did in January? I'm not sure. I think it probably looks better than it did in January, although it looked pretty good in January. I mean, if we went back and looked at the 2020 chart, it was up big in 2020 also. But generally, I try to stay away from anything with a chart that sort of starts to look like it's going parabolic, which means that instead of, like we looked at the S&P, is pretty much a diagonal line going up and to the right. So when the line just gets steeper and steeper and steeper and steeper, that, usually is bad news. The good news on Moderna is, though, if you bought it before about a week ago, you're still sitting on a pretty nice profit. But yeah, so let's go look at the chart for Moderna. All right, so let's put it in candlesticks so we can see the individual days and go out to, say, year to date. Yeah, so it went from a little over 100 to, it looks like it just short of $500 earlier this week. But again, right, with the stock at 385, it was below that every day in its history by $20 on the 2nd of August, which is, what, 9 days ago? So almost everybody who owns Moderna stock has a profit on it, and probably a pretty good one. So I don't, yeah, I mean, this happens. But again, right, this is what I mean when I talk about a stock going sort of parabolic is, you know, it gets sort of steeper and steeper and steeper and steeper until it's practically going straight up. And this is, is this meme stocks in terms of a bunch of retail traders jumping in and bidding it up? I don't know. I mean, their earnings were good. The outlook looks good, right? Like they're going to keep selling those vaccines, you know, and hopefully make some more vaccines for other tricky diseases. But just from, you know, years of looking at stock charts, this doesn't keep happening. This always leads to this, you know, this big red candle over here. It's kind of just how it works. Because, yeah, at a certain point, people are sitting on an awful lot of money in profits, and the the fundamentals just don't support it, and so people get out. Yeah. All right. Is there a way to see the management of a company's insider holdings? So typically the absolute holdings in terms of, right, like how many shares does somebody have aren't super useful. What's much more interesting is the buying and selling of the stock, which is, you know, sort of flows, right? So stock, if you think of stock as like one number that sort of sits somewhere, versus flows as, you know, a sort of rate, right? Like shares per day, or, you know, something that's actually happening as opposed to something that's sitting. But yeah, we have that covered in our news section in terms of the actual activities. If you go to the news section and then hit insider activity, you know, here's a big list of the trends. And these also show up in the news section on the individual stock pages. Yeah, that's that one. And I believe that is the last of the pre-submitted questions. So let's go and see what people asked while I was talking. All right, so Salvatore asked, in the daily picks, in regards to the covered calls, which is, you know, in the covered calls and elite service, you get a covered call trade in your morning update every morning. He says the trade says this trade lasts 9 days. I understand that it expires in 9 days, but are these intending to create the underlying assignment of shares so we are left solely with the premium and don't have to worry about holding shares? Yes, that is the goal. That's why, you know, all the calls are written very close to, or sometimes even below, maybe a little bit above, but pretty much very close to the stock's current price. You know, you write a call, you know, buy some shares, write a call against them, make some amount of money in 9 days. It turns out that if you're doing a bunch of 9-day trades, the annualized returns get to be pretty high, just because it's, you know, make any reasonable amount of money in 9 days, you know, and try to do that over and over again. It does okay. All right, so Eric asked, is IO useful for future traders? It's not really what we do here. So you may be able to find some value of it, but that's not necessarily our goal or intention. So John, this is live. I put the slide together before the close because the presentation started at the close, so I didn't get the exact number that Moderna is down. I think the slide said 75, which was in the question, versus 71, but yeah, this is live, I promise. All right, so we have a question, should I sell Xpev? This is one of the Chinese, I think this is electric cars. Yeah, this is a Chinese electric car company. And yeah, I mean, the best answer I can give you is I don't know. China hasn't cracked down on the sector yet. If you have a big gain on it, certainly it never hurts to sort of take some off the table, especially since the stock seems to be riskier now than it was, a couple weeks ago. But yeah, again, right, like this is another company that doesn't make any money. And so my guess is China's probably pretty happy to let capital flow into the country, right? I mean, if China can compete with GM on the world stage, they would be very happy with that. And so if they can, sort of solve the electric car puzzle before GM and Toyota and some of those other big names get online, they'd be pretty happy to do that, and they'll happily take your money to sort of help them. Whether or not you think that's a good investment or a good thing to do from, I don't know, some sort of non-purely financial standpoint is another question you can ask yourself. I can't answer that one for you. But for now, China has shown no real inclination to crack down on the electric car sector. I don't really expect that they will anytime soon, to be honest. But I do think that, sometime before this company gets to be the size of General Motors, if that ever happens, I am very curious to know if capital will be allowed to flow out of China and back to the foreign investors. So, yeah. Question about CLF. All right, Cleveland Cliffs does, yeah, I think it's iron ore. They used to do coal, but I think they got rid of the coal piece. And so it's just iron ore now. But yeah, it's been pretty hot recently. But the price to earnings ratio still doesn't look terrible. Yeah, I mean, the chart doesn't look right. Like you can see this is a little bit more, it sort of ran up here and then went up too high and sort of flattened out and didn't go anywhere for a while. But this more recent action is noisier, in terms of just bigger ups and downs, but the trend is sort of in the right direction without really knowing a lot about the company's internals. I don't have a lot to tell you not to recommend it, but I don't see anything in looking at it and just knowing about iron ore that makes me think that it's a terrible idea. Commodities do tend to be perhaps a little bit risky, but that is something that should be known. And by risky, what I really mean is mostly volatile, right? I don't think that iron ore is going to stop being a thing that people want anytime soon. Really, the question is, at a certain point, you get problems with, the commodity sort of cycle looks like the price for a commodity goes up. So companies spend a lot of money and invest a lot of equipment and things to produce as much as possible, and then the price of that commodity goes down, and maybe some of the companies were a little bit over leveraged and they get in trouble that way. That happens with a lot of things. Cleveland Cliffs has been around for a long time. They got out of the coal business, which seems like a good idea. But yeah, as of right now, it certainly seems okay. All right, so all right, so the question we have here is, if I'm looking for short-term credit spreads, about 1 to 4 weeks, which of the indicators should I focus on the most? And yeah, the guess is stock sentiment and short-term technical, and yeah, that's right. Those are pretty much the those are the short-term indicators. You maybe don't want to look for something that's just pegged against the the top on the stock sentiment. Sometimes that can be good. Sometimes that can be a sign that something's about to turn around. but yeah, those are the things that I would look at. All right, so Dave says, how does the overall score factor in when looking for a bearish trade? The description says a low score means there isn't much of a bullish case for the stock. Yeah, I mean that's kind of what I said earlier about sort of turning the analysis upside down, right? Like if XYZ has high scores, it's probably a better thing to go long. If it has all low scores, it is potentially a thing you could think about shorting. We sort of steer everything towards long investments because most investors are long only. So that's just kind of how that works. But certainly if you want to try to turn things around, and look for things with low scores, you can absolutely do that. So in terms of, I would probably pay more attention to the short-term technical score over the sentiment in terms of something that went 1 to 4 weeks, just because the sentiment score looks at literally the last 5 days, and so it can be sort of noisy, right? Like it can move around a lot, whereas the short-term technical score looks at a longer period of time, it's closer to a month. And so you get a little bit less sort of noise there. One good day can send the sentiment from one end of the scale to the other, whereas it takes a much better day to do that for the short-term technical score. All right, Digital Turbine. I think apps. Yeah. So the question is, despite Digital Turbine repeatedly reporting blockbuster results, the stock continues to lag. Could you comment on that? I mean, it ran way up in February from less than 60 to 90, which is a 50% increase. And yeah, it's back closer to 60 now, but this is also not a small move from 20 to 60 is also a 300% increase. So yeah, I mean, it's been sort of flat here, but you made an awful lot of money in this period of time. And so yeah, this is again, right, a thing where we talk about stocks getting kind of ahead of themselves. But yeah, also, I mean, it has a price to earnings ratio of 104, which is, I think old school people would tell you 15 is fairly valued. More recently, something on the order of 20 has been about the average. Whereas 104 has never really been considered fair value. Now the PEG ratio, which takes that price to earnings and divides it by a growth rate, is pretty close to 1, which honestly suggests that it's at about the right price in terms of being fairly valued at the current price, given sort of price to earnings ratio and the expected growth rate. So yeah, really, I think the answer to your question is, the price here was too high, right? Like every time it started to shoot up like this, it went right back down. And that gets back to that, sort of psychology thing I was talking about before, where, I mean, you can love a stock as much as you want, but when you're staring at a, from 20 to 90 in like 7 months, it's really hard not to take some of those profits. It's and so that's what you see is it goes up and then it goes back down. It goes up real sharp and then goes back down. So this all seems pretty normal. And again, this company does It does what I would describe as hard to define technology things, right? Like nobody's buying things directly from Digital Turbine. It's entirely a sort of business to business thing. And so it probably has a lot of competitors, and I'm not sure exactly what it has in terms of a moat, which means sort of, would it be difficult for another company to come in and do what Digital Turbine does? You know, it's hard to get that book of business in terms of calling up a bunch of companies and making the sales, but this sort of thing isn't super hard to set up, right? The thing that makes Salesforce a giant company is it's, you know, just has a lot of customers and it's bought a lot of smaller companies. And at this point, it can offer a package that's really hard to compete with just in terms of the sheer number of things it can do. Whereas these smaller companies, they tend to have a lot more competition, including from brand new players. And that can make, you know, those giant valuations a little bit scary for people. All right, so Jeff said, regarding the trade of the day, covered calls in the morning email, if you don't want to spend $300 for a stock, is it safe to say those stocks would be good candidates for diagonal spread? Yeah, that's certainly a thing you could do. I don't necessarily, I haven't tried to look at the diagonal spreads. The diagonal spreads may be a little wide also. But yeah, that's certainly a way you can do it. The diagonal spread will always be less capital intensive than the covered call. All right, I feel that Square has more room to run after it bought Afterpay. Yeah. Square's another one that's up just a lot, I guess, yeah. It's only up 100% over the last year from 140 to almost 280. And this one, yeah, I mean, okay, so here the PE ratio is 233, and whereas the last stock we looked at, the PEG ratio was pretty close to 1, here the PEG ratio is at 11. Square has been not necessarily a meme stock in the sense of, you know, not like GameStop or Hertz or something like that, but if you look at the 5-year chart on Square, it's nuts. Right, this move is a lot. Like we just looked at the 1 year, and this move from, you know, 34 to, well, I guess it was 200, but even to the base here at 222. Yeah, that's a lot of room for a stock to go up. And I know the company has been growing fast, but it hasn't been growing as fast as the stock has been going up, which is always a little bit concerning. And I don't think Afterpay adds that much, right? Like it's Australia, their economy isn't huge. They're essentially doing lending, so I don't know how easy that is, right? Like I don't know if they can necessarily just launch that service in the United States, because there are some sort of regulated activities there. So yeah, I'm not sure that works. All right, so Dave says, I think Dave, you're misunderstanding the option screener. Yes, the amount at risk is like most other things. Start over here. The prices are in, you know, per share bits, let's say. So, you know, for bullish diagonals or bullish verticals, yeah, the amount at risk here is going to be per share. So if you put in 100, yeah, I don't know very many people who do vertical spreads at an at risk of $100 per share, but if you put in $1, you will get, where'd my at risk column go? Nothing more than essentially $100 per contract. Right, there you go. It's per share. And lots of options things are quoted like that, right? Like options prices are all quoted on a per share basis and not a per contract basis. All right, so Dinakar asked, can I provide your view of investing in SPACs as an alternative to clear accredited investor status? Yeah, I mean, the idea of accredited investor status is the people who can qualify for that should be more sophisticated consumers of financial products. Now, whether or not having more money actually makes you a more sophisticated consumer of financial products is sort of up for debate. But that is the theory anyway. I've talked a bunch in these presentations and sort of elsewhere about not really buying into the SPAC thing, especially as frothy as they got earlier in the year. I mean, I understand the argument in terms of it kind of lets you maybe get into a company a little bit early, whereas you couldn't if you're not an accredited investor. But yeah, I don't necessarily see them as one-to-one. And in general, it's hard to make blanket statements about either one. Like, I think a lot of crap gets marketed to accredited investors. They do have some opportunities to buy good companies before the retail investor does. And I think some SPACs work and play off, but if you look at the sort of success rate of SPACs as a whole, there's an awful lot of garbage out there. And yeah, if you look at SPACs, most of the SPACs now compared to where they were in, say, January and February, it's pretty ugly. So yeah, I mean, it really is a thing that you need to take on kind of a case-by-case basis and try to get involved in a bubble. I think both of them can work out, but I think it's hard to make a blanket statement because I think there's a lot of, I get press releases about things that are being offered to accredited investors, and a lot of that seems like garbage or, something else too. One of the nice things about being a retail investor is there are very high sort of disclosure requirements. Whereas that tends to be less in terms of both SPACs and the accredited investors, which means you're buying into a lot fewer things, right? I mean, like I showed you that chart with Didi earlier in the corporate structure, right? Like all that was known before they went public, right? But stuff like that maybe doesn't have to be disclosed to either accredited investors or SPAC investors, and so I tend to not spend a lot of time in either one of those spaces. All right, yeah, so our stock page does show an earnings date here, right? So Apple's next earnings date is the 4th of November. And we will show the next dividend date when it's available. Apple went ex-dividend a week ago, so the next dividend hasn't been declared yet, so we don't have an estimated dividend date, but we do have those on the pages where we know, or at least have a good idea of when it's going to happen. All right, so one more Chinese stock, YSHL. One I'm less familiar with. Yeah, I mean, this company is on the pink sheets. It otherwise trades over the counter. So, I mean, yeah. Your guess is as good as mine about stuff like this. I mean, in terms of shipbuilding and offshore engineering, that seems like it fits into my broader thesis about, essentially electric cars and drones and things like that, right? Like, this is tangible stuff that can help China project power around the world. But yeah, beyond that, I don't know. And yeah, pink sheet stuff can get to be very, in addition to all the other, disclosures and things about Chinese stocks, the pink sheet stuff gets to be even more opaque in terms of what the business is or how it's doing or whatever else. The reporting and disclosure requirements are even lower than they are for stuff that's on the NYSE or the Nasdaq. So it's basically impossible for me to tell you if this company has ever even built a ship, based on what I know about it, just cold. All right, I think that brings us to the end of our time. I think I got to everybody's questions. If I didn't, you can always submit questions using this help button here. We don't make you save your questions for one of these presentations. Certainly, I think it helps in terms of just being easier to get things answered if I can show you along with just type it out. But, like I said, I'm always happy to get questions for the workshop. But, if you have some question that's holding you up or you just need to know right now, you can send us a question through this thing pretty much anytime, and we get back to most of those same day. So yeah, thank you for coming to this workshop. Thank you for subscribing to Investors Observer, and I will talk to you again soon.